Welcome to the deep dive. We've got a stack of analysis here looking at some really interesting global economic and political shifts. And our mission, as always, is to cut through that noise for you. We want to give you a clear picture of what might be happening behind the headlines: U.S. trade, the economy, markets, even a close look at Mexico.
Right. And what's interesting is how the analysis connects these dots. Things that might seem totally separate.
Yeah.
You start seeing these underlying patterns, these tensions playing out.
Exactly. So today we're going to unpack a legal fight over U.S. tariffs. We'll look at that back and forth between the White House and the Fed. Markets, too, what's going on there. Surprising stuff from NVIDIA, Apple, plus the outlook for U.S. government debt. And then Mexico is that stability we see hiding something deeper.
A lot to get through.
Okay, let's dive in and unpack these insights for you. First up, this major thread the sources are tracking, a legal challenge that's really hitting U.S. tariff policy. What's the core issue the analysis flags here?
Okay, so the analysis points to a district court ruling. It basically found President Trump went beyond his authority. Under the IEPA, that's the International Emergency Economic Powers Act, for some tariffs, the court deemed those decisions unconstitutional. Void, actually.
Unconstitutional and void, okay. But the tariffs didn't just vanish overnight, did they? What happened next?
No, they didn't. The appeals court stepped in pretty fast and suspended that district court ruling. But, and this is key from the analysis, it was a transient suspension, temporary. So for right now, the tariffs are still in effect. It's like a suspension of the suspension, if that makes sense.
Right, okay. A pause on the pause. So here's where the sources say it gets really interesting. The White House is expected to ask the Supreme Court to weigh in, and quickly. What if the Supreme Court agrees with that first court, the district court?
Well, if the Supreme Court does side with the district court, saying the IEPA wasn't the right tool here, Trump still has other options, according to the analysis. Congress put other channels in place. One lets him impose tariffs up to 15% for a limited time. The sources mention 150 days, so about 5 months. He could potentially switch to that immediately if the IEP path is blocked.
But only for 5 months.
Initially, yes. Making them permanent would mean going back to Congress for approval. And that, as the sources stress, is a much slower legislative path.
Got it. So for you listening, what's the status right now, today?
Right now, you're basically back where things were a couple of days ago. The tariffs are on, but there's this big question mark hanging over them, pending whatever the Supreme Court might do.
And what's the bigger picture take from the analysis on this whole legal drama?
The analysis sees it as a serious procedural stumble for the administration. Even if they ultimately find a way to keep the tariffs legally, it makes the whole U.S. legal framework for trade look less solid. The analysis uses the phrase, not rock.
Not rock solid? And what's the implication of that?
It could potentially weaken the psychological position of U.S. negotiators. You know, when they're sitting down with Japan or Britain, Europe, China, it just adds a layer of uncertainty about the U.S. position.
Okay, makes sense. Let's shift from the courts to economic policy then. The sources flagged a key meeting today, Fed Chair Jerome Powell at the White House. What did the analysis pick up from that?
Well, you get two different stories, which is interesting in itself. The Fed put out a statement saying Powell stressed, decisions depend on data. They're keeping options open, basically on standby, no fixed plan. But then the White House spokesperson's version said Trump repeated his view that Powell's wrong and needs to cut rates now.
Really highlights the tension there.
Yeah.
And this connects to a wider debate the sources dive into, the fiscal picture. There's this new fiscal package, the big, beautiful bill, as it's called, passed the House, now in the Senate. What's the financial impact look like based on the CBO and Tax Foundation numbers the analysis uses?
Pretty significant. The analysis suggests it adds trillions to the deficit, maybe around $3 trillion, including the interest costs over time. Or even if you count potential tariff money coming in, still at least $2 trillion. And this really pushes up the debt compared to the size of the economy. Debt to GDP projected to hit maybe 128% or 126% by 2034, even with tariffs.
That's a record.
A record, yeah. And interestingly, the sources also mentioned analysis suggesting that any boost to GDP from this spending, it gets basically canceled out by the drag on GDP from the tariffs. Kind of a wash.
Okay, so the conventional wisdom usually says more government debt means higher interest rates. Simple, right?
Yeah.
What does the source material say about where rates are headed with all this?
Yeah, this is where the source offers a really interesting counterpoint.
Yeah.
It basically says, hold on, that common sense view might be a common error for a country like the U.S. The argument is the Fed doesn't just react mechanically to government debt levels. What they're really watching is aggregate demand.
Aggregate demand. Remind us.
That's the total demand in the economy. government spending plus all the private spending by businesses and consumers. And they look at that relative to the economy's production capacity. So the point is, if government spending goes up, but maybe private investment or consumption pulls back because of uncertainty or tariffs, total demand might not actually surge.
Ah, okay, so it's the net effect.
Exactly. The Fed, according to this analysis, will wait and see what the net effect of both the fiscal bill and the tariffs is on overall demand and, crucially, inflation. Tariffs might cause a one-off jump in some prices, sure. But if the bigger picture is weakening overall demand, the Fed could still end up lowering rates.
So what's the projection then?
The source suggests long-term rates might bounce around current levels for a bit, but likely head lower next year. Maybe the 10-year Treasury yield drifts down toward, say, 3.75% or 4%, maybe even lower, and short-term rates potentially down to 3.5%.
Fascinating. So how's the market taking all this legal and fiscal uncertainty? The S&P 500 bounced back recently.
Yeah, the market analysis in the sources points this out. It suggests the S&P is trading at levels like, targeting near 6,000 points that seem to assume average U.S. tariffs don't go much higher than, say, 11 or 12%. You started talking about tariffs getting up to 24, 25%, which comes up elsewhere in trade talk. The analysis says those levels are just incompatible with where the S&P is now.
So the market's pricing in a relatively contained trade war outcome. What about specific sectors?
Recently, industrials and utilities have been doing well, leading the pack, while energy and healthcare stocks have been lagging a bit behind.
Okay. And the big names, the Magnificent Seven, what's the analysis there?
Well, NVIDIA stands out. Just extraordinary results and guidance, even with those China export restrictions. The analysis explains their H20 chip strategy for China.
Right.
It's a slower chip to meet the rules. But here's the twist. Sales of that specific chip in China are actually expected to drop, basically to zero.
To zero? Why?
Because, according to the analysis, China's own domestic chip alternatives are now seen as better and cheaper than that specific NVIDIA export chip. And this leads to a really interesting argument in the source material. It says limiting these high-end chip sales is like shooting yourself in the foot.
How so?
It uses this analogy, like cutting off a teenager's allowance often pushes them to get a job and become more self-reliant. Limiting chip sales is essentially forcing China to speed up its own chip design and, crucially, its manufacturing capabilities. The risk highlighted is that once China really masters that advanced manufacturing, U.S. companies could lose that huge market permanently. They'd be facing a really tough, cost-competitive rival.
Wow, that's a sobering thought. And how does Apple fit into this picture?
Apple's actually the worst performer in that Mag 7 group this year, down about 17.7%. The analysis links this, in part, to President Trump's stated focus, maybe obsession with getting Apple to make iPhones in the U.S. The source analysis calls this impossible in the short term, says it would take at least 3 years, maybe more, to even set up. And it would massively increase the cost. We're talking potentially $2,000 plus for an iPhone.
Ouch.
Yeah. And then Apple also suspended its own guidance recently, which just adds another layer of uncertainty for investors.
Okay, quite the contrast between those two tech giants. Let's shift focus geographically now. The analysis gives us a really detailed look south at Mexico's economy.
It does. And the consensus forecast presented there paint a picture of, well, very sluggish growth. We're looking at maybe just 0.1% growth this year, barely moving, and only 1.5% next year. These are big downward revisions, by the way. Mexico's central bank, cut its own forecasts quite a bit. It leads to a projected average growth of just 0.5% for the start of the next government's term. Really low.
0.5% average growth. Wow. What about inflation and interest rates?
Inflation forecasts are more moderate, around 3.9%, near the target range. And Banxico is expected to keep cutting interest rates. The consensus sees their main rate around 7.5% by year-end, though the source analysis itself thinks it could go even lower, maybe towards 6.5%.
So low growth is the main story. How does the analysis interpret that?
Crucially, it argues the economy is running significantly below its potential. There's this concept called the product gap. Basically, the difference between actual output and what the economy could produce at full capacity. That gap is expected to be almost 3% by the end of this year. And it gets worse if growth stays this weak.
And what does that mean for people, for jobs?
Yeah, formal job creation is projected to be very weak, maybe 110,000 to 290,000 jobs this year. Bit more next year, but still far, far below what Mexico needs given its population growth, and much lower than job creation in recent years.
Okay, so you have this picture. Low growth, weak job market. But the Mexican peso has been really strong, hasn't it? Seems counterintuitive. What do the financial numbers show?
It does seem counterintuitive. The analysis breaks down the Q1 balance of payments data. Mexico ran a small current account deficit that's trade in goods and services. Income flows about $7.6 billion negative. Nothing too alarming, but this was easily covered by a much larger surplus in the financial account. Money flows from investment around $37 billion positive. That came from FDI and portfolio investment.
Okay, $37 billion inflow. Where did that come from?
Here's a really important nuance the source points out about the foreign direct investment, the FDI. About 70% of that headline FDI number was actually reinvested earnings.
Reinvested earnings, meaning?
Meaning profits made by foreign companies already operating inside Mexico that they decided to keep and reinvest there rather than sending them back home. Now, it's still a positive sign they're reinvesting, but it's money that was already generated within Mexico's economy. It's not necessarily new cash pouring in from abroad to build, say, brand new factories. It changes how you interpret the inflow.
Got it. So it's not all fresh foreign money. What about the other part, portfolio investment?
On that side, there was quite a bit of foreign buying of Mexican bonds, about $10.9 billion in Q1. The source analysis links this quite directly to a large bond issuance the Mexican government did in dollars, also around $10.9 billion. So foreigners bought those government bonds.
Okay, so putting it all together, a $37 billion financial inflow easily covered the $7.6 billion current account deficit. What happened to the leftover dollars? That's a big surplus.
Exactly. It created a surplus of dollars floating around in the Mexican economy, about $30 billion just in Q1. So where did they go? Two main places, according to the analysis. First, Mexican residence companies, individuals, the big pension funds called AFORs. They actually invested heavily outside Mexico. Total outflows were around $30 billion, buying foreign stocks, bonds, ETFs. Second, the central bank, Banxico, was actively buying up dollars itself, adding about $11.1 billion to its foreign reserves.
Okay, so that's the link to the strong peso. The central bank buying dollars, Mexicans sending money out.
Precisely. The source argues this big underlying dollar surplus puts natural upward pressure on the peso it wants to appreciate. And here's the core insight from the analysis. This surplus exists not necessarily because the economy is firing on our cylinders and attracting tons of new investment for productive means, but partly because the economy isn't growing much.
Wait, how does low growth create a dollar surplus?
Think about it. If the economy is sluggish, demand for imported goods is weaker. Businesses and consumers aren't buying as much from abroad, so fewer dollars are needed to pay for imports. Meanwhile, dollars keep coming in from fairly stable sources, exports, which haven't been hit too hard by trade issues, and remittances from Mexicans working abroad. Add in the financial inflows we talked about, even the reinvested earnings and bond sales, and the dollars just pile up if import demand is weak.
So the dollars accumulate because they aren't being spent on imports.
Largely, yes. And Banxico buying reserves is them trying to soak up some of that excess supply of dollars to prevent the peso from getting too strong, which could hurt exporters. Cutting interest rates also makes holding pesos slightly less attractive, potentially dampening inflows.
So how does the source summarize Mexico's situation then?
It says Mexico has robust financial stability. The external accounts are solid, reserves are high, they have access to international credit lines. There's no imminent risk of a balance of payments crisis or a sudden, sharp currency crash. But, and this is the crucial point, the analysis hammers home this financial stability exists alongside and is partly a consequence of deep economic stagnation. The source argues that this lack of growth, the lack of dynamism and opportunity is the real underlying challenge, the real crisis preventing progress.
Stability through stagnation. That's quite a take. One last detail on Mexico, the sources mentioned a remittance tax. What's the deal there?
Yeah, the source notes a proposal for a 3.5% fee on money sent home by Mexicans abroad. It apparently passed the Chamber of Deputies, one house of Congress, and is now being discussed in the Senate. Now, here's a slightly confusing bit as presented in the source material. It says it needs President Trump to promulgate it before it can actually change anything. That seems like a potential misunderstanding or misstatement within the analysis itself, but that's how its status was described.
Okay. Well, that's certainly a lot we've unpacked in this deep dive. We've gone from U.S. legal challenges, shaking up trade policy, to the Fed versus the White House, market jitters, surprising company stories, and then this really distinct picture of Mexico stable on the surface, but maybe stagnant underneath.
Yeah, and you really see that tension playing out across the board. Just as the analysis suggested, you have elements of resilience, right? U.S. markets holding up, assuming tariffs stay manageable, Mexico's strong financial buffers preventing a crisis. But coexisting right alongside that are these underlying weaknesses or uncertainties, the U.S. legal and fiscal knots, Mexico's growth problem. And the analysis makes that compelling point. Even apparent strengths, like Mexico's strong peso, can actually be symptoms of deeper issues like weak investment and demand.
It really drives home how interconnected everything is. Legal rulings, politics, corporate moves, central banks, investor psychology, basic economic conditions. It's all tangled together in ways that aren't always obvious.
Absolutely. And thinking about this whole picture, stability, sometimes masking stagnation, uncertainty, lurking beneath market confidence, it maybe leaves you with a provocative question to chew on. What does all this tell us about how we should define economic health or progress?
Is financial stability on its own really enough if it's not accompanied by growth that actually creates opportunities for people?
Something to think about.
Definitely something to mull over until the next deep dive.